Everybody, it's Al from Boston. Let's kick it off. Today, I have a very special guest. I'd like to introduce our next guest. He holds a BA from Columbia University, a Juris Doctor from Columbia Law, which he graduated magna cum laude. He was elected to Phi Beta Kappa. He was also partner at the international law firm of Paul Weiss, Rifkin, Wharton, and Garrison LLP out of New York City. He serves on multiple boards, including a member of the U.S. Chamber of Commerce and the Board of Visitors at Columbia. He is currently the CEO of Virtu Financial, one of the nation's largest market makers in the United States. And most recently, he has been affectionately dubbed by the internet as the liquidity fairy. Please welcome Mr. Doug Cifu.
Thanks for having me, Alex. I
Doug,
appreciate
welcome.
it. And that was a very, very lovely introduction. So
Thank
thank
you
you.
so much. So we'll get down to it. We know you guys have limited time. I want to
hmm
start off with the Madoff exemption. The Madoff exemption allowed market makers like Madoff to sell short stock to facilitate a customer buy order.
Yeah.
Even if the stock in question was ticking downward, short sales on a downward ticking stock were prohibited at the time. Do you think that's a fair thing? Do you think the Madoff exemption as a whole is a fair deal for everybody?
Yeah. Look, I mean, to take a step back. What is a market maker, and what's the role of a market maker? And that's what we do here at Virtu, which is to, as you say, facilitate marketplaces and to act as a financial intermediary between buyers and sellers. Without market makers, and frankly, I used to jokingly, and this never went over well, say it's the world's second oldest profession, right? Because when you had, think 200 years ago, when farmer, whatever his name was, Farmer Joe had excess corn, et cetera, and wheat that they couldn't consume, in their community, they took it to like the town, like Kansas City and Midwestern towns, and then Chicago, right? And they would meet at like a central location in the town where they would try to sell their excess goods and obviously that they couldn't otherwise consume themselves. And individuals began to gather around those posts that didn't necessarily want to consume it themselves. They would buy it from Farmer Joe and then sell it to other consumers or sell it to somebody else. And so that was the process of how marketplaces evolved, which is why the New York Stock Exchange is called the Buttonwood Exchange, and why exchanges originally had these kind of posts that people gathered, and the folks that gathered closest were originally called specialists or market makers, right? So that very, very important financial intermediation function has always been recognized in marketplaces, right? And so whether we are buying or selling a security, a financial instrument, we don't really have a directional view or a notional view on whether that's going to go up or down in the long term. Frankly, we trade 25,000 different financial instruments in 50 different countries. So whether a stock or a FX pair or a commodity product that's either a future or spot or now a crypto asset or an option, all the different things that we do, whether they go up or down is sort of irrelevant to us. Obviously, we're trying to we work for a profit called the bid-offer spread. The difference between what willing buyers and willing sellers are prepared to pay for an instrument, and we're taking risks because we're bridging that supply and demand. We're bridging the time between buyers and sellers when they're going to come to market, et cetera. So to get back to your question, the regulators saw that, well, that's a different type of an investor, a different type of a participant in the marketplace. And as long as they're engaged in what is known as, I used to be a lawyer, as you mentioned, bona fide market making activities, right? We should permit those individuals to be able to sell, as you say, on a downtick. And marketplaces around the world, this is not unique to the United States, even when they ban short selling or even when they put in like a financial transactions tax, they recognize that if an entity is engaged in bona fide market making activities, that is a good and necessary thing to the marketplace, and so therefore it should be permitted. Without that, you would have liquidity gaps, you'd have inefficiencies in the marketplace, and ultimately that just means that bid offer spreads would widen and natural buyers and sellers are going to pay more. So to put it all in that context, I think it makes a lot of sense. Even when there has been bans on like short selling, as I just indicated, most times regulators will, like during the financial crisis when, and I think this is idiotic, but when Congress said, all right, we're going to ban short selling in financial instruments, there's a reason why Lehman went to zero, right? It had nothing to do with a market. Even then, market makers were exempt from those bans, because regulators recognized that there needs to be, for the good efficiency and the working of a marketplace, you needed these financial intermediaries to be able to buy and sell at will. And so that's the kind of basics of managing supply and demand. So I understand by calling it the Madoff exemption, people then reach some conclusion that it's nefarious because Madoff had a market-making business and obviously had a Ponzi scheme as well on the 17th floor, or whatever the hell it was, in the Lipstick Building up in New York. But at the end of the day, that very important financial intermediation function has been recognized, as I said, for hundreds of years, and by regulators globally. This is not just a United States phenomenon. I hope that was responsive to your question.
Sure. Frank?
Mm-hmm.
Doug, we've heard the axiom over
Frank
and
from
over
Chicago.
again.
Yes.
Frank from Chicago.
Yes.
We've heard the
Let's
axiom
go Hawks. Yeah.
over and over again. If something's free, you're the product.
Yeah.
Does a market maker on its own have any inherent conflict of interest?
No, I mean, you're asking a question, I think, in the context of payment for order flow or rebate. And I have said publicly, and I will say again, and this is not like, Gary Gensler unearthed the Rosetta Stone in the sands of Egypt. There is a conflict when an exchange, an ATS, or a market maker, a wholesaler, a market center, provides a rebate back to a broker, whether that's a retail firm or whether it's the New York Stock Exchange paying a rebate back to a broker-dealer, whether it's Virtu or it's Goldman Sachs, it's JP Morgan. There are conflicts all the time in financial services. The way that conflicts, as you mentioned, I used to be a lawyer, the way that conflicts are always dealt with in financial services is through disclosure and regulation. And so 30-odd years ago, right, the SEC, and it has evolved over the years, recognized that when a broker, in this case a retail broker, is selling an order and receiving a rebate back from a venue, whether it's us, right, or whether it's Citadel, or whether it's the New York Stock Exchange, because the retail brokers are sending orders to exchanges and getting rebates as well. Right? It's just not called payment for order flow; it's called a rebate. So there's a conflict. As long as they're disclosed, as long as they're regulated, as long as investors are aware of them, right? There's nothing inherently pernicious or so horrible about them that those brokers shouldn't be permitted to do that, in my view, as long as they are continuing to satisfy their own best execution obligations, right? Think of all the conflicts in financial services. I use this example, and I said this to to Chairman Gensler. Virtu is a public company. Goldman Sachs right now, where Gensler used to work, covers Virtu as they have a research analyst that covers Virtu. He has a hold on our stock, so he's not telling investors to buy it. If we were to go to Goldman Sachs today and say we need to raise capital, which we don't, but if we went to Goldman and said we need to raise capital, we want you to sell $500 million of Virtu stock to a bunch of hedge funds and other investors in the marketplace, and give us, your best efforts to do that in an underwritten offering in the next 48 hours. What do you think they would do, Frank? They would say, absolutely, we'll take that. We have to disclose. They will disclose to us, and they will disclose to their investors. They have a conflict. They have somebody at Goldman behind a wall that doesn't think that Virtu stock's price is going to go up, that you should hold it. You shouldn't be buying it. But their equity capital markets division would gladly take our business, charge us 2-3%, whatever it would be, and would sell $400 or $500 million of stock. That's a conflict. Right? Is it any worse or better than the conflict when a retail broker sends an order to Virtu or to Citadel or to some other wholesaler or to the New York Stock Exchange or NASDAQ? I don't know. I don't think so. It's a conflict. Let's deal with it. How do you deal with a conflict? You disclose it. There's regulation on it, which is why every time, Frank, you read a research report, there's a page of disclaimers and disclosures that institution puts out regarding its conflicts. So there are conflicts in financial services. The thing that I find so disappointing is when the chair responds to the question, like you mentioned, or I've seen people reference that John Stewart asked him, and he acts as if it was like some new thing. Payment for order flow and the concept of sending orders to wholesalers has been around in this marketplace for 30 years. Nothing new. Nothing new.
I see.
So on CNBC, when you stated PFOF is an expense, and if
Yeah.
SEC vacated PFOF, your P&L would be higher. Is that factually true, or would you still hold that position after you said that, or no?
Sure, it's an expense. We're writing a check every month to Schwab and to Morgan Stanley, now E-Trade, and to Robinhood. I mean, it's hundreds of millions of dollars. So obviously, they charge us, for the flow that they're sending us, and they charge the exact same rate to every wholesaler, whether it's Virtu, Citadel, Jane Street, UBS, Susquehanna, Two Sigma, Hudson River Trading. I mean, there's 7, 8, 9 of us that are competing for those orders, right? So it's a very, very competitive marketplace. So to the extent, that rebate went from 10 cents per 100 shares, which is generally what like Schwab charges, to zero, that would benefit us. Now, obviously, they would probably expect some level of perhaps a price improvement or this or that, whatever it is. But at the end of the day, that is an expense of Virtu that shows up in our financial statements under, I think we call it BC&E, broker commission and exchange costs, right? So it's literally hundreds and hundreds of millions of dollars. Within that is also what we're getting charged by the exchanges and ATSs here and around the world. But that's a huge expense of our firm. So to the extent that went from hundreds of millions of dollars down to zero, naturally you would think that our net P&L would go up, which naturally would lead you to the question, Alex, why am I then so vocal about this? Well, I run a client-facing business, and my clients, that's the deal that we have with our clients. They have the same deal with all the other wholesalers, number one. And number two, I actually do think, right, sincerely do believe that the provision of that rebate has fostered competition. The reason there is zero commission trading today in the United States is because of the new business model, if you will, that Robinhood introduced to the marketplace 6, 7, 8 years ago when they, began their service. There's been a lot of copycats to Robin, the Webull's of the world, and it forced the larger retail firms, Schwab, Fidelity, E-Trade, and others, to offer a zero commission alternative to their clients. And so ultimately, at the end of the day, billions of dollars of commissions that otherwise would have been paid by retail investors to retail broker firms have been, remain in the pockets of retail investors. I think that's a good thing for the marketplace. I think competition is a good thing for the marketplace. And so therefore, that's why we as a firm have been very front-footed on this.
Go ahead, Frank.
Well, you see, I'm very comfortable when Doug speaks about payment for order flow framed that way. I guess where I depart is when it's a market maker, also has an ATS, and is also a hedge fund, is where I become concerned.
Yeah, those are conflicts. We run an ATS at Virtu. Okay, we run, right? So, but it's a separate business, and so does Goldman Sachs, and so does JP Morgan, and so does Morgan Stanley, and so does UBS, right? So does every financial services firm. Why do we run ATSs, right? Is because at the end of the day, and this is the reason originally why retail brokers actually formed the company that we bought, Knight Capital. It was originally called the Knights of the Round Table, because Frank, they don't, and a lot of our institutional customers don't like to send orders to exchanges because it's expensive, and they don't like those orders, particularly if it's a large institutional customer, exposed to the world. It's not a lot of fun to trade on an exchange if you have a gigantic order that you want to either buy or sell something, right? Because those obviously can impact the prices of ultimately what you're gonna pay. And so institutions created ATSs as a way for them to mitigate the costs that they would otherwise have to bear themselves or charge to their investors, to their clients, right, for executing an order. Right? Exchanges are expensive. They serve a great purpose. We're one of the biggest customers, believe it or not, on the New York Stock Exchange and NASDAQ, as is Citadel. So it's not unusual for financial services firms to have both a market-making business, a brokerage business, and an ATS, right? We do not have a hedge fund business here at Virtu Financial, and I obviously understand that Citadel does. That's all segregated, they're highly regulated, and they're examined by regulators all the time. I understand all the conspiracy theories out there about Citadel and what happened with Robinhood. I think they're all completely fallacious and there's no validity to them whatsoever, because I interact all the time with Citadel. So you're not going to get me to say anything negative or bad about Citadel.
That wasn't the point, Doug.
Okay. So, no, I appreciate that, and I respect that. And I think, look, the SEC looked at that. They obviously understood that there were concerns about it, and the SEC put out a very long, fulsome report about all this, and it was all addressed, and everybody, they concluded that there was really nothing there. That was an unfortunate period in the marketplace. I think the report indicated very clearly that Robinhood had issues meeting its margin call at the NSCC because of the significant imbalance and the price volatility. I understand very well how margin calls happen at the NSCC, and the NSCC said to Robinhood, look, you're either going to have to shut down or you're going to have to take orders that just reduce your exposure, i.e. buy orders. And that's really what happened. And so there's nothing more to it than that.
So I've got a quick question.
Sure.
We're going to talk about AMC for a second. AMC preferred stock 8 had 43 million FTDs. It had 13 halts on the first day of trading, while a stock like a Chinese stock like HKD was running 28,000%, had 7 halts in one day of trading. It's very inconsistent. How would a market maker define this phenomena, and how do we fix these the disparity between the two?
Yeah, let me tell you something. We hate trading halts at Virtu, okay, for the record. I mean, they are very difficult for us to deal with. When there's huge imbalances in the marketplace, we don't have any magic elixir where we say, okay, well, the stock's going to go up or down, right? As I said before, we're the best thing for a market maker, right, is for a stock to kind of go up and down all day and finish the day where it began, right? Because at the end of the day, we're trying to capture a bid-offer spread. When a stock is just going in one direction, we're typically going to lose money and get run over. It's a hard thing for us to deal with. Trading halts are dealt with and completely prescribed by the national securities exchanges. So we have nothing to do with them. The issuer has nothing to do with them. So you need to look at what the New York Stock Exchange and NASDAQ and CBOE and what the other listed exchanges have promulgated as what they call volatility halts. So when a stock goes up a certain percentage during the day, right, the idea was, in order to gather liquidity and give investors an opportunity to ascertain really what's going on and what the right price should be for that stock, a stock gets halted. So you brought up the example of HKD, right? That is an absolute disaster of a stock. It never should be a listed public company. In my view, it's probably, some form of manipulation going on overseas. As you said, it went up 22,000%, and it had a enterprise value where that entity was momentarily or for a moment in time had a higher enterprise value than JP Morgan. It's obviously absurd. It makes no sense. That is not our responsibility as a market maker. There's a listed exchange that listed that stock. It must have satisfied its listing obligations. I'm sure the SEC was frankly just as annoyed as we were that thing was actually trading, because a lot of good people probably lost, a lot of money, investing in that stock or trading that stock. So that's not how, our marketplaces should function. And again, I would look at the listing exchanges that listed that. In that instance, it was NASDAQ, and say, why are you listing this garbage? Right? It's not what should be listed. I mean, the company barely had any revenues, and all of a sudden it's worth $300 billion. Something is very, very wrong. So it's not a situation or a trading environment that we relish. In fact, it's a pain in our ass. I'll say it, because as a wholesale market maker, right, or maybe Andrew's telling me HKD, is NYSE listed, so I don't mean to disparage NASDAQ. It's 3 letters. I should have known that. It's New York Stock Exchange. So the New York Stock Exchange probably shouldn't list that thing to begin with. But as a wholesale market maker, when retail clients send us orders, even in that name, we have to take them, right? At that moment in time when that order hits our environment, right, we have to satisfy it, whether it's a buy or a sell. So when that stock is ripping up, guys, and people want to buy it, we're selling it, and we're getting shorter and shorter, and we're losing money. So that's not a great situation for us. So it's not all like, apple pie and roses over here in those situations either. So nothing would make us happier. Nothing would make us happier than these crazy low float names that tend to come out, from outside the United States, that get listed on our national securities exchanges and end up, creating these large, trading disparities. And I know, to give Gensler credit, I know he is sympathetic to that because he has looked at, the auditing standards, for example, of Chinese listed firms that need to be consistent with U.S. GAAP listing standards. So I think the SEC actually, it's an issue where the SEC has been very front-footed on as well. So that's, unfortunately, it gives the entire industry a real black eye, and it's a terrible situation that I wish the exchanges would do a better job in rectifying.
So I want to talk real quick about dark pool and how its original intent was for institutional purchases, and now we're seeing just volumes and volumes of retail orders flowing through. Quick comment on that, and we'll get to the last couple questions, and you guys can.
Yeah, as I said before, I mean, there's, I don't know how many ATSs there are registered in the United States. I'm sure there's over 100, but there's probably, 30 to 40 very meaningful ATSs that are, unfortunately, we have a terrible marketing problem in the industry that people call dark pools. So therefore, people think that there's some something pernicious about them. They're really just what they are, alternative trading systems, alternatives to, national securities exchanges, and they don't typically, although they can become an ECN, but they typically don't have lit market data, as you say. So, but all trades in an ATS, guys, happen at the NBBO or better, right? So they're all happening at the same national best bid and best offer that you would see on the reference price on an exchange. Mm-hmm. So it's not like there's, and we are a market maker in all the different dark pools, as are literally dozens and dozens of other financial institutions. So whether or not volumes get routed there ultimately is the decision, not of Virtu, but of the retail broker that has that order. So if you're a Robinhood customer, Robinhood has a choice. It can send that order to an exchange. It can send that order to an ATS. It can send that order to a wholesaler. Its decision is based on where it thinks that order and those orders that it handles is going to get the best execution, right? Is the best price that is at or better than the national best bid or best offer. That is 100% the broker's responsibility. We have a similar best execution obligation, and we get surveilled by FINRA and the SEC on it consistently. So again, if you have investors, and if you guys, for example, don't want to use a broker that sends orders to a wholesaler, don't want to use a broker that sends orders to an ATS because you think, for whatever reason, and I would think you're wrong, respectfully, I would disagree with you, but this is America. You have a choice. There are brokers out there that I'm sure will, one, not take a rebate, and two, send your order to a national securities exchange. I don't know exactly who they are because I'm not in that business, but I'm sure there are, and you probably know the names of them. At the end of the day, in my view, right, you're going to get a worse execution. If you don't care about that, and maybe you don't believe me, and that's fine, you don't have to, then send your order to that broker, and that broker will send the order to the New York Stock Exchange or NASDAQ or CBOE or one of those 15 national securities exchanges, right? And then you'll see it show up in the market data, and if you feel better about that and that makes you feel more comfortable trading, then God bless you. This is America. Go do that. I don't care. Ironically, who do you think the market makers are in all those national securities exchanges? Who's going to be on the other side of that order anyhow? It's going to be Virtu. It's going to be Citadel. It's going to be Jane Street. It's going to be Jump Trading. It's going to be all the same firms that are wholesalers, and then additional firms that don't have wholesaling businesses. So if you think that's a better way for you to execute your order, then you're going to lose the benefit of that order being segmented in this retail ecosystem. And so your price is going to be worse. And this is demonstrable. The evidence is very clear. It's all out there. You're going to get worse execution. If you trade once a month, does it really matter? Probably not. You'll pay a little bit more for the stock, and hopefully, I wish you well. I hope the stock goes up, and that'll get lost in the wash. But if you just compare the Rule 605 or Form 605 statistics that are out there between wholesalers, i.e. the market makers, and the exchanges, right? And this is all public. It's all by rule. It's on websites all over the place, and you just look at the execution quality of market makers as compared to exchanges, it's just night and day, right? And again, that's because of the segmentation of the order flow. So again, this is the point I've made to the SEC and I've made publicly. If you as an investor don't believe anything I just said, and you don't believe the Rule 605 statistics, or maybe you don't care about execution quality, and you want a broker that will avoid a wholesaler or an ATS and send your order to an exchange. That choice exists today. That choice exists today. So go to that broker, and maybe they're going to charge you $8.95 per trade. I don't know. I don't trade. I have no clue. I mean, I run a trading firm, but I don't trade personally. And you can go route that order to an exchange and be happy.
Doug, I got one.
Yeah, I got a
this.
question on that too.
Yeah.
All right, let's talk Wall Street bets for 1 sec. Here you have a group of radicalized retail investors. This is a global phenomenon. You got people from every country, every kind, with no regard for their own money, and though willing to accept losses. These people are not going away. They're sustainable because every 2 weeks they get a paycheck, and they're willing to spend this money on here. And these guys are like, hey, screw it. Let's just leave it, and we won't capitulate even in this market. What is the most probable course of action for a market?
Yeah, but I don't know what they're not capitulating against. I guess there's this theory somehow that like Virtu and Citadel and the other wholesalers
I think it's Citadel more than Virtu.
Okay, but somehow Citadel is dramatically short AMC and GameStop and these other names. I don't have any idea where that came from. I don't. I can't comment. I don't have, Citadel's not sharing their internal books and records. I will tell you, for the record, on this Zoom webcast, which is covered by Rule FD, right? So I'm the CEO of a public company that over the last year we have been long and we have been short AMC and GameStop. It is completely and utter happenstance which way we are. I don't have any personal animus or view on AMC or GameStop. If you ask me as an intelligent, thoughtful guy who's been a corporate lawyer and now running a trading firm for the last 30 years, what do I think about the movie business? And do I think it's got great prospects? I could give you an answer, but who cares what I think, right? Read a research report from an analyst that spends time looking at movie theaters. I know Cinemark filed for bankruptcy just because I read a lot of stuff, but I don't frankly care. If AMC went to, I don't even know what the stock price of AMC is today. I have no clue. If it went to 100 or 1,000, I'd be happy because a lot of people would probably make some money, right? And when they make money, then they'll trade more. I don't care. It will have zero impact on Virtu, right? If we're short if we're short AMC today, I don't even know it. And if we are, it's probably a couple $1 million. And then tomorrow we'll be long a couple $1 million. We go back and forth depending upon where retail clients are buying or selling, right? We're just facilitating the trading, as I said. So today we could be long, we could be short, we can go back and forth, and we may end up the day $2 million short. And then tomorrow, the same thing's going to happen. We could end the day $500,000 long, right? It's just complete and utter serendipity. So I would imagine that Citadel is doing the exact same thing. So this whole theory that people came up with, that there's these gigantic synthetic shorts and there's these $1 billion of short positions that are going to be closed out. I just, as an intelligent, thoughtful guy that was a practicing lawyer for 18 years and now runs a trading firm, that's just not possible. So I kind of feel bad, I guess, for lack of a better word, about people, as you just posited the question, that would take their hard-earned money and invest in something on that theory that somehow this thing's going to go to $100,000 or $10,000 or $1,000 or go to the moon, however those folks describe it. I think that is probably not a great investment thesis. But again, it's America, so if people want to do that and continue to do that, they can do that. Idiotically, occasionally I wade into social media on this topic. I tried, like I suggested, have the CEO of AMC, I forgot his name.
Adam Aron.
Yeah, have him come to Virtu. I'll explain how we market make, and I'll show him my books and records. I don't care.
Doug, do you know where I think some of the confusion comes from?
Ultimately, look, I'm a blue-collar guy, right? My grandparents came to this country from Italy illiterate, couldn't read and write. I used to read the cartoons to my grandmother, right? I know how hard they worked. My father worked his ass off to put me through college and law school. I worked my ass off to create Virtu and make myself a success. So I work really hard for my money in the same way that good people do. I don't want to see people piss away their money stupidly, right? I think that's a sin. So I'm happy to have Aaron come to Virtu. We'll fucking webcast it. I don't care. I got nothing to hide. Right? I'm very proud of the business we built. I don't know the guy. I don't know where he is. I don't know if he thinks this is a good thing or a bad thing, this whole retail phenomenon. But at the end of the day, this notion that there's billions and billions of dollars of secret shorts out there in Citadel, and I guess Virtu are going to have to cover them someday. I'm telling you, it's bullshit. It's bullshit. So, like, I kind of feel bad. Like, Frank, you're a good guy. You got a great Italian last name, right? If that's your investment thesis, I don't think it is because you seem like a smart young man. I don't want you to lose your money doing that. That's why I get involved in this. Maybe I shouldn't. Maybe I should just go read a book and go home.
Let me respond. I should clarify that Anna Marin himself said there weren't any synthetic shares. So
did he? Okay.
I'd like to dispel that and remove that from the conversation. He actually came out and said that. I think the confusion for some of the investors.
I don't follow it that closely, to be honest with you.
I know.
I wasn't trying to disparage. I wasn't trying to disparage Mr. Aaron. I don't know him from a hole in the wall, and I'm sure he's a successful guy.
No, first of all, I think that AMC has been around for 100 years. I think it's going to be a great turnaround story, and that's why I'm an investor. I really do.
I hope so. Good. Knock on wood. I hope you make a lot of money, Frank. I really do.
But here's where I think some of the confusion comes from. When we see utilization at 100% from February, okay, and shares show up every morning. We had FTDs come out. I think they come out twice a month from the SEC.
Yeah, but do you know what an FTD is? I do. You do. Do you know how the continuous net settlement system works at CNS or excuse me at the NFTC?
I was wrong at first, Doug. Somebody corrected me and showed me how
it's just like a bank account that just rolls every day. So like continuously throughout the day, and that's why it's called the CNS, continuous net settlement system. Right? Every trade we do, we just immediately send because we're a direct clearing member of the NSCC. There are some trades that trade DVP, but assume it's CNS, and this is the way you create efficiency. So every day we could have a fail to deliver. We can have a debit or a credit in literally the 10,000 different names that we trade. It's total serendipity as to what's happening in the marketplace and how people are actually clearing and settling the trades. So I do think you're reading into some data that really cannot be read into in the way that you're reading into it.
But on that same day, when I see the FTDs for Google were like 92, Apple 11,000, and AMC 2.1 million, you could see how we might get suspicious.
Yeah, of course,
right?
Of course.
Okay,
that's all. But those first two stocks that you mentioned are much more institutionally traded, right? So you're going to have gigantic asset managers that are trading those by the large broker dealers as opposed to AMC and some of the smaller retail names, right? So they're just not going to, the settlement system with regard to those is just going to be more challenged, Frank. That's really what's going on. So you should.
Understood.
Yeah, look, you seem like a very reasonable, nice guy. Alex, you served your country. That's why I responded to this because I felt all right, these guys are decent guys. I want to at least try to get some, get our point of view out there, that kind of thing. I'm telling you, there's nothing surreptitious going on. Could there be better disclosure around borrowing and rehypothecating and John Stewart sitting there talking about the short volume on some of these things, and I'm thinking to myself, I got an overnight talk show host now is talking about rehypothecation in the securities lending market, and I'm thinking if we haven't jumped the shark now, I don't know what's going to happen next. Fucking Jay Leno's going to show up and start asking me about fails to deliver. I mean, it's people that have no idea what the hell they're talking about. I'm not trying to disparage you guys because Frank, it looks like you've done some homework at least, are coming up with these theories that just makes no sense. The settlement system in this country is a little archaic and it's very, very detail oriented. And it's there aren't a lot of people that really understand it. It was very clear from that podcast that Gensler doesn't really understand it. And he shouldn't, right? He's never been an equities guy. The only reason I understand how it works is because I started a broker-dealer, right? And we're a direct clearing member of the NSCC. So, do I have any idea right now what our failed to delivers are with the NSCC? I have no idea. We're publishing our financial statements on November, I don't know, Andrew, 4th or 5th or something like that, November 3rd. He just held up 3 fingers. And so you'll see it in our 10Q. I have no idea what our failed to deliver balance will be. It's complete serendipity. On September 30th, 2022, if a bunch of brokers had sent a bunch of stock to us, our FTD balance would have been a hell of a lot lower than it otherwise is. So it's absolute and utter and complete serendipity.
Doug Cifu from Virtu Financial. Thank you so much.
Great talking to you guys. You guys are good guys. I wish
Thanks
you
a
luck.
lot, Doug.
I really
Thanks.
wish you guys success with everything you do. All right, be well.
Thank you so much, Andrew. We appreciate everything. Thanks
All
for
right.
being on the show. And God willing, one day, maybe somewhere down the line, you guys can come back and talk about
I love it, man. I love it. All right.
Hey, good
And-
luck on the hockey, huh?
Yeah, let's go Panthers. All right, root for us. We need the help.
All right,
We
we'll talk
will.
to you.
All right, cheers.
Bye-bye.
Thanks, guys.
Thanks, Doug.